Accepting risk or risk acceptance occurs when a business or individual acknowledges that the potential loss from a risk is not great enough to warrant spending money to avoid it. Also known as risk retention, it is an aspect of risk management commonly found in the business or investment fields. Risk acceptance posits that infrequent and small risks, ones that do not have the ability to be catastrophic or otherwise too expensive, are worth accepting with the acknowledgement that any problems will be dealt with if and when they arise. Such a trade-off is a valuable tool in the process of prioritization and budgeting. Accepting risk or risk retention is a conscious strategy of acknowledging the possibility for small or infrequent risks without taking steps to hedge, insure, or avoid those risks. The rationale behind risk acceptance is that the costs to mitigate or avoid risks are too great to justify given the small probabilities of a hazard or the small estimated impact it may have. Self-insurance is a form of risk acceptance. Insurance, on the other hand, transfers risk to a third party. In addition to accepting risk, there are a few ways or alternatives to approach and treat risk in risk management. They include avoidance. This entails changing plans to eliminate a risk. This strategy is good for risks that could potentially have a significant impact on a business or a project. Transfer, applicable to projects with multiple parties. Not frequently used. Often includes insurance. Also known as risk sharing, insurance policies effectively shift risk from the insured to the insurer. Mitigation, limiting the impact of a risk so that if a problem occurs it will be easier to fix. This is the most common. Also known as optimizing risk or reduction, hedging strategies are common forms of risk mitigation. Exploitation. Some risks are good, such as if a product is so popular there are not enough staff to keep up with sales. In such a case, the risk can be exploited by adding more sales staff.